Statistical arbitrage, step by step with examples. Statistical arbitrage involves exploiting short-term mispricings or statistical relationships between financial instruments. Below is a step-by-step guide to implementing a basic statistical arbitrage strategy, along with examples. Step 1. Identify a pair of correlated securities. Example: let's consider two technology stocks, Company A and Company B, that historically have exhibited a strong positive correlation. The correlation suggests that when the price of one stock moves, the other stock tends to move in the same direction. Step 2. Gather historical data. Example: collect historical price data for both Company A and Company B. This could include daily, hourly, or even minute-by-minute price movements over an extended period. Step 3. Calculate correlation. Example: use statistical tools to calculate the correlation coefficient between the two stocks. A correlation coefficient close to +1 indicates a strong positive correlation. Step 4. Develop a statistical model. Example: use the historical data to develop a statistical model that predicts the future relationship between the two stocks. This model could be based on linear regression, co-integration, or other statistical techniques. Step 5. Establish a trading signal. Example: if the model predicts that the price of Company A will outperform Company B in the short term, generate a trading signal to go long on Company A and short on Company B. Conversely, if the model predicts the opposite, establish a trading signal to go long on Company B and short on Company A. Step 6. Implement the trade. Example: execute the trades based on the generated signals. This could involve buying shares of Company A while simultaneously selling shares of Company B in the appropriate quantities to maintain a market-neutral position. Step 7. Monitor and manage risk. Example: continuously monitor the performance of the trading pair. Implement risk management measures, such as setting stop-loss levels or position size limits, to control potential losses. Step 8. Close positions. Example: once the statistical relationship reverts to its historical mean or the mispricing corrects itself, close out the positions. This might involve buying back shares of Company A and selling shares of Company B. Step 9. Analyze results. Example: analyze the results of the statistical arbitrage strategy. Evaluate the profitability, the effectiveness of the statistical model, and any areas for improvement. Step 10. Refine and optimize. Example: based on the analysis, refine the statistical model and optimize the strategy. This could involve incorporating additional data, adjusting parameters, or exploring different statistical techniques. Important considerations. Transaction costs. Consider transaction costs, such as commissions and bid-ask spreads, which can impact the profitability of the strategy. Market conditions. Be aware that market conditions can change, affecting the validity of historical statistical relationships. Risk management. Emphasize rigorous risk management to protect against unforeseen events or extreme market movements. It's important to note that while this example provides a simplified overview of statistical arbitrage, real-world implementation can be considerably more complex. Additionally, individual investors should exercise caution and thoroughly understand the risks before attempting to implement statistical arbitrage strategies.